Hello, this is Mark Harrington from mybitcoinprofits.com. Over the last couple of days, I fielded a question about what actually drives the value of Bitcoin. And as you know from my series of videos, I've been asking the question about how correlated Bitcoin is to other markets. So today I'm going to take a step back, especially given that Bitcoin is still firmly in that triangle, to have a look at what drives Bitcoin value. And I'm going to step right back to compare it to other commodities, other markets, other instruments to see what the values of driver actually are and how it differs from other markets. And I'm going to start by looking at a currency. And the currency, as I've chosen on the chart, and I've chosen for a very particular reason, is the Australian dollar compared to the US dollar. And the very specific reason that I've chosen it is on this chart. You'll see this chart starts in 1994. So this is the beginning of the end of 1993. It's a monthly chart, and the importance of that, as you can see, there's no data before this, is that this is when the Australian dollar was floated freely. So it could be traded freely against all other currencies, so without intervention in the currency markets. So, and you'll see that it's gone up and it's gone down and it's gone up and it's gone down in a progressive way. So we'll just go and explore what are the factors driving that. And I'll just put some brief notes up here is that the trite answer to the question is it's driven by supply and demand. And I've seen that offered as an answer many times in Bitcoin markets. It's driven by supply and demand. Well, in the currency markets is what are the elements of supply and demand? Well, the first one is really easy, is that the supply of money is influenced and determined by the Reserve Bank in the country in which it operates. So the supply of Australian dollars is influenced by the Reserve Bank of Australia, in the same way as the supply of US dollars is influenced by the Federal Reserve Bank of the United States. And then where all the transaction activity happens, you basically go into two broad buckets. Is the flow of trade between countries. So when somebody sells something, so we sell iron ore from Australia to someone in China, a Chinese guy has got to plunk down his Chinese renminbi, convert them to Australian dollars to pay for the iron ore that he's purchased. So trade flows, imports and exports are a key contributor. The second contributor is capital flows. And that's the flow of investment capital into the country. So when a Chinese company chooses to buy an Australian iron ore operator or power station or farm, as they've been doing in the last months, they need to find Australian dollars to pay for the assets that they purchase, so for the investments they made. And then, of course, equally, when one of the Australian banks chooses to invest in a bank in Vietnam, they need to sell Australian dollars to buy Vietnamese currency to make that investment. So capital flows is an important source of supply and demand factors. And of course, what we must not forget in here is the movement of capital in and out of stock markets. Less of a factor in Australia, but something that has to be taken into account. And I've just added on this list a word called intrinsic value. That is not important in a currency market, but in gold, for example, gold has an intrinsic value. It is an intrinsic value because the material can be converted to industrial demand as a conductor or jewelry demand, or it has an intrinsic value because it's viewed as being valuable. So the heart of understanding value is to actually understand the flows in and out for supply and demand. So let's just try to look at the whole story of the Australian dollar. And the first thing I'm going to do is let's just have a look just briefly at trade flows. So what I'm going to do is I'm going to put onto the chart I'm going to compare this chart to the gold price. So I have here a chart that's going to be, it's a gold and silver index, and the reason I've picked that one in particular is that the data goes back far enough. And we'll see here pretty easily that as gold price has gone up, as the gold price has gone down, as the gold price goes up, as it drops, as it rises, as it drops, as it rises, as it drops, as it rises, as it drops. A bit of an anomaly here, something different happened here. As it rises, we see the Australian dollar rising, the dramatic fall of the GFC, and then the rise after that, and then the turnover at the top, and then the drop. And this one is mirrored as well. So we can see pretty clearly that the Australian dollar follows the gold price very precisely. And that's no surprise, because Australia is a large exporter of gold. Now I'm going to put onto the chart, I'm going to compare it. So say let's think about other metals. And for this one, I've chosen as a proxy for the copper price the stock price of Freeport Moran, which is a large American producer of copper, and its price should pretty well mirror the copper price. And we can see here when we've got a flattening over here, or if I can get my pictures to work properly, flattening over there which mirrors that one there, a drop in price, a flattening, a small rise in price. We've got this dramatic rise up here, and the Australian dollar has basically tracked that. The fall of the GFC, the turn is almost identical timing of the turn, the correction of the flash crash. This is a classic chart showing a very high correlation between the copper price and the value of the Australian dollar. So that pretty well deals with trade flows. I've not looked too much at what the impact of imports are, because trade flows in Australia are dominated by commodity flows. We could look at agricultural prices and to see how those work. I'm not going to do that for now, because the data I have for it does not go back to give me a tidy comparison to 1994. Now, the next thing I'm going to look at is that we're looking at capital flows. Capital flows from low interest rate environments to high interest rate environments. That's an important area of capital flows, and particularly if we look at government bonds, particularly where the credit rating for the respective governments are the same. And Australia is a AAA rated credit rating country, and the US is a triple rated credit rating country, so the government bonds between the two countries are comparable. So I'm just going to pop up a chart. The chart here shows, well, it did show the differential between Australian and US 10-year government bonds. So starting over here, and our chart starts here, so 94. So we've got a rising, falling, going level, rising to 2002, going level for a while, dropping to 2006, the run up to the GFC, the drop off at the GFC, and the run up since, and then a long decline since 2010 as progressively Australian interest rates have been falling and US interest rates have been rising, or the difference between the two shows that those are falling. Now I'll put those arrows onto the chart and do a little bit of cheating to do that. So I'm basically going to I've written all those rises and falls down into a note, and then I've just written them up in this box here so we can see where my cursor is. So we'll see from 93 to 96. we have interest rates rising. So I'm just going to draw a chart on here. So from 93 to 96, I have interest rates rising. 96 to 98, I have interest rate. So this is the yield between the two. 96 to 98, which is about there, falling. 99 to 2000, we've got a period of going sideways. That's 99 to 2000. 2001 to 2004, we have interest rates rising. So 2001, so that's from here to 2004. That looks like 2004 to me. 2005 to 2006, we have a fall in interest rates. And then we'll have to make sure it registers the other end of the arrow. 2005 to 2000, 2006 to 2008, we have a rise. That's up to there. We've got the calamitous fall in 2009 with the GFC, and then from 2009 to 2011, we have interest rates rising. 2009 to 2011. Well, that is November 2011 is pretty well the top, and 2011 to now we have interest rates in Australia falling compared to the United States. Now, isn't that pretty remarkable? If I move this arrow up here, we have an incredibly high correlation. As we have interest rates rising in Australia, the Australian dollar rises, and we have interest rates dropping, the Australian dollar falls. And that pretty well mirrors pretty precisely what we saw in commodities, is that there's a very high correlation. So what that tells us is the Reserve Bank is monitoring commodity prices closely as a proxy for where interest rates should be, and the economy is mirroring drops in commodity prices and showing that it needs signs of help when commodity prices have dropped dramatically or sufficiently, and the Reserve Bank steps in to help. So that tells us an interesting story. And I'm going to get rid of all of these arrows for now, because I think the case is made that there's a very high correlation also with interest rates. The last thing I'm going to look at as a part of capital flows is I'm just going to compare this market to other stock markets. So for that one, I will use as a proxy, I'll use an index, the S&P 500, so the US market. So well, let's just see what the chart's telling us. What the charts are telling us is we have a long run up in US markets from 94 to 2000. We've got the fall off with the dot-com crash, which ran for 3 years down. And then we've got a long run up. We have the long run up to the GFC. We've got the collapse at the GFC, and then we have a long run up with one small hiccup here since March of 2009. And we've got, I said there was one hiccup, is we've got the recent hiccup over here. So that's what the S&P 500 look like. And we have not yet talked about what it compares to the Aussie dollar. So what I'm actually going to do is I'm going to get rid of the S&P index and just leave the arrows in place. So what you see is that, yes, we had a run up here. So we had the run up here, which in Australia, Aussie dollar fell off while the market continued to run up. So that tells me the correlations are somewhat low. This run down here does mirror this one. This run up here is, although this run up stops here. This run down continued here, whereas the Aussie dollar had already turned the corner. And as we go up here, we'll see that the S&P 500 peaked somewhere before the Aussie dollar peaked. So the Aussie dollar actually lagged here. The Aussie dollar turned a little bit earlier than the bottom of the GFC. And this one here, the Aussie dollar turned earlier than the US. This is the flash crash in the US, and we see very clearly here that there is this is almost 2 years, 3 years ahead of this last turn, if in fact that is related. I suspect those are not related. So there we see there is not a very high correlation between the performance of the Aussie dollar and the performance of the US market. So much more importantly driven by the differential between interest rates and the rise and fall of commodity prices. So what has that all got to do with Bitcoin, you might well ask? So let's just step across to Bitcoin and let's have a look. I'm going to change this to a weekly chart for Bitcoin. Now, Bitcoin started in 2009, and for a long time, this exchange, which is the longest running exchange, is Bitstamp. For a long time, Bitcoin price just totally went sideways. So if we're going back to our drivers of value is supply and demand. So if we look at the first thing we want to understand is what was the supply of Bitcoin. And as you know, Bitcoin started in 2009. It was mined pretty aggressively early on, and then the rules of Bitcoin is that with increasing difficulty, the number of Bitcoin that become available starts to diminish. So there's a curve for Bitcoin, which is the total Bitcoins in circulation. So I have pulled this out. This is the whole life of Bitcoin. So we can see essentially Bitcoin has flattened out from January 2012. There was still a growing number of Bitcoin available, and so from January 12 we've got 7.9 million available, and we've got a doubling of Bitcoin available from January 12 until now. So we still have supply is increasing. So as you can see here, if I do a 2-year chart, you'll see that supply is still increasing on a reasonably linear basis. So there is progressively increasing supply, but it is, when I present it on a log scale, you'll see that it is flattening out. What we've got here is, while we've got this big build-up going in Bitcoin, the question you've got to ask yourself is, what were the Bitcoin miners doing with their Bitcoin? Well, the answer lies, as I've already mentioned, Bitstamp started as an exchange in around January 2012. So there weren't too many places to exchange Bitcoin. So basically what those miners were doing is they were holding on to their Bitcoin. So there is a core of miners, the people who started mining early, are holding on to Bitcoin because they are waiting for the opportunities to exchange, or they believe that it has intrinsic value. Now let's look at other factors that will drive the value of Bitcoin, and that's looking at the demand side. Who actually wants Bitcoin? And the answer to who wants Bitcoin, well, we can see in the transaction levels from the beginning. So what we have here is these are the daily transactions on from the beginning. As you can see, in the early days, we're looking at 100 transactions a day, and now we're looking at 200,000 transactions a day. So what I actually do is I'm going to take some of the noise out of the chart. And in the process of taking the noise out of the chart, I got my scale back. This is just doing a 7-day average, so there's just fewer data points on the chart. So what you'll notice on here is that the chart is no longer linear. because linear would look like that, and this is actually looking like that. So it's got more of an exponential shape to it. So that's the first element of demand, is we have growing places that one can use Bitcoin to purchase transactions. There is a growing number of exchanges in which you can exchange Bitcoin for other currencies, so that the people who were holding on to large piles of Bitcoin are now in a position to exchange their Bitcoin. So let's now step back to the chart, the Bitcoin chart, and let's see what it is showing us. And the first thing that strikes me is that we do have this shape. It's much more extreme than the transaction chart would suggest. So if I just go back to the transaction chart, you see that's the sort of shape. This is much more extreme than the transaction chart would suggest. Yeah, I think this line here was drawing from 2012. So we could argue that it's similar, but I think this one is actually steeper than the transaction value would suggest. So the driver of value is coming from somewhere else. And let's just think about what those somewhere else's may be. The next chart I have is looking at specific events, and to determine what the specific events have increased or decreased the demand for Bitcoin. This again is a chart. This is at all times. So you'll see in January 2009. So that's when the first block was established. I'm going to ignore all of these items here. 16, WordPress accepts Bitcoin. Item number 17, there's a halving day. So this is a technical term, and this is some important to us, because if we've got a halving day here, there's been some impact on the price chart. Is that related to the halving day? I don't know, but we want to know that over here, because we've got a halving day coming up fairly soon. Event risk is often argued as being important. So a macroeconomic event like the freezing of deposits in Cyprus, it could well result in an increase in the demand for Bitcoin, and consequently the price. We have new exchanges coming in. The Mt. Gox story is certainly playing a role in here, but let's pick out 22. Trade Hill shuts down again, so that's an exchange that's falling over. Dread Pirates, Roberts arrested. So 24, US Senate holds a hearing on Bitcoin, and they clearly didn't say bad things because the Bitcoin price kept rising. The People's Bank of China okays Bitcoin. That's a very important decision, because China has capital controls, and for Chinese people to get access to Bitcoin means ultimately they can move their money out of China without capital controls. 26, we have the exchange rate peaks on Mt. Gox. Mt. Gox falls over, and we get this catastrophic fall. Mt. Gox fall over was there is when the government bans financial institutions from using Bitcoin, so the price dropped dramatically. So they say, yes, it's okay for people to hold it, and then they say financial institutions can't hold it, and the price goes from 750 to 1250, so up by nearly 50%, and then drops by the same amount again. The denial of service attacks always impact Bitcoin. This is always never going to be a surprise. Mt. Gox closes and the price collapses. The Chinese exchanges, their bank accounts are closed, the ones related to Mt. Gox, and the price goes. And then we start to see an improvement. This is a fork decision. That's a technology decision. And then if we go into more recent activity, a new exchange, we see price moving up. The EU declares no VAT on Bitcoin trades. That is an important driver of volume of trades. And as we get Bitcoin's featured on the front page of The Economist, public awareness, that's never going to be bad for Bitcoin performance. And then if we have a look in more recent time, the chart's not got the data on there. When Michael Hearn announced that he was going to quit the Bitcoin Foundation and sold his Bitcoin, the price moved quite dramatically before he made his announcement, which tells me that he sold his Bitcoin before he made his announcement. And this is always a factor in these sorts of markets, remembering that the Bitcoin market is an unregulated market. So you are going to see transactions which might just look a little bit like insider trading, because there is no obligation to report information that is going to drive the value of price, and there's nothing to stop people trading on information that is going to drive the price. So stepping back to our chart here, is pretty confident that this run-up is driven by increasing transaction usage for Bitcoin, the Chinese announcements about acceptance of Bitcoin, the Chinese announcements up here about not allowing financial institutions to hold Bitcoin has certainly had an impact on prices. The Mt. Gox failure has certainly had an impact on prices. And then we've got a progressive decline here. Now the question is that driven by markets or not? So let's just have a look quickly at this and do what we did with the Australian dollar and just compare it to other markets. So stepping back to our Bitcoin chart, I have no doubt that this run up here, 2012 onwards, is based on that step up we saw in transaction ability, or transactability, if there is such a word. This step up here is based on China saying that it's okay to use Bitcoin. This step down is also based on China. So they said financial institutions could not participate. And then this one here is to do with Mt. Gox and the general nervousness. And then as we step across here, let's just have a look at the timing for when the EU was making its announcements about the EU announcements about which is around here, was the exempted Bitcoin from VAT from here. So that's October 2014. So October 2014. Well, it's this small thing here is October 2014. So yeah, you can argue that it's had an impact. The announcements about capital controls in China is here, and here we have the drive up because of that factor. Now, just quickly say, now can we say there's a correlation with the US markets? I will put the US markets on the chart the same way as we did with the Aussie dollar. SPX, S&P 500, and we know that this change here is to do with transactions. We've got the US market progressively climbing over here, so one can argue that the US market's rising, people are selling their Bitcoin to participate in the US market. We've got it going sideways for a while, sideways up to here, and then it continues going sideways while the US market has dropped. So that would suggest to me that there is less correlation, and then we have this run up which starts at about the same time as the Chinese capital controls, and these things are starting to look a bit similar. So there's the overview of Bitcoin and how it derives its value. And maybe we'll just summarize it quickly in some words in here. So the supply is flattening. We are dependent on early holders not dumping, and if they believe that this is going to grow long run, there's no reason for them to dump other than to pay for mining equipment. And we have got growing transaction demand, and we are dependent on regulation impacts, because we know that when the EU makes a VAT announcement, it had an impact. Capital controls announcements have an impact, and we've just had today the Australian government has said no GST, so that will have an impact for Australian holders of Bitcoin. But we're particularly dependent on other events, because events that we've not talked about, Silk Road, the Silk Road seizure and auction, definitely had an impact on the market. And the reason it has an impact on the market is that we have 15 million Bitcoin in circulation times a current price of $400 is $400 equals 6 billion of market capitalization, which is a business smaller than WhatsApp, for example. It's an absolute net compared to almost every country economy in the world. So, yes, it will be influenced by large transactions, but it's not going to influence other markets. So that's where we are. As a summary, happy Bitcoining, and may the price continue to rise.